Brigade Enterprises is a stock in focus. The reported numbers relative to Bloomberg estimates look much lower because the revenues down 27% YOY at 653. The estimates were 954. Margins actually stable and improved YOY. Net profit 38 versus expectations of 76 and a reported number of 87. But because there is a change in the reporting pattern, if you look at just purely the pre-sales, they did a pre-sales of 996 crores, which was a growth of 22%, and collections at 1244 crores, if I'm not wrong, which are up about 2.8% YOY. Ms. Pavitra Shankar joins in to put the numbers into perspective and just tell us about how the scenario around real estate is currently. Actually, I should call it Pavitra Real Estate plus Hospitality plus plus. But let's put this quarter into perspective, because when I look at the optically reported numbers relative to what Bloomberg estimates were, they're much lower. You want to kind of put this into perspective?
Yes, sure. Hi, and thanks for having me. Yeah, so what you're seeing really is the mismatch between sales numbers, which typically need to be converted into registrations at the end of the project life cycle when it is registered to the customer and handed over. So the accounting standards changed a few years ago, where we had to stop reporting revenue as basically bookings value, and now revenue is basically based on the Ind AS 115 standard. So we recognize it based on actual registrations. So what happened this past quarter, couple of different reasons. While we have the available units to register, in fact, we have a number of projects coming up that are close to completion and handover. So I feel it is just a timing difference. This past quarter, or at least Q1, we've actually had some few issues with the new registration system in Karnataka. It's called Kaveri 2.0, and it's basically the software being used by the sub-registrar's office, which will eventually streamline and actually become a lot more efficient. But right now, there's a lot of teething issues with the software on ground. So it also took some time to implement. So basically, some of the registrations have been pushed. What we'd have liked to see in Q1 are actually happening in Q2, and then should be able to continue at a good pace. Also, approvals in general have kind of been slower. So that will also have some kind of impact in terms of getting OCs on time, and then therefore being able to go ahead and register our customers.
Okay. Would you reckon that sentiment is changed, or is this merely operational issues at the powers to be end, which is impacting performance? And I'm guessing that would probably be true for most of the companies operating in that area.
Yeah, this issue affects all of us, especially those who have a heavy concentration in Bangalore or the state of Karnataka, which is certainly applicable to us. The changes at the approval side is definitely as a result of the state government change. But I think these are things that should iron out down the road, and hopefully should, sort of not be impacting us soon. In terms of sentiment, the sentiment on ground is excellent in terms of demand for residential real estate. We are able to sell inventory, move it pretty quickly. Launches are getting lapped up, across the board. Despite where in people's thoughts on inflation or whatever it may be, housing loan rates have sort of stayed at 8.5% or so, and there's a lot of good demand from customers whenever we're looking at new launches, or even those that were launched in the last couple of quarters. And we're also able to take up pricing. So I think that shows a very healthy outlook for the residential sector. And what we're seeing is just a dichotomy of, or really a timing difference of making the bookings. But by the time you can construct the property and then hand it over to customers, that's going to take your average cycle of around 3.5 years. So it'll really only hit our revenue numbers once we register the sale lead and hand it over to customers. So I would say it's just a leading indicator of good numbers to come. But generally, we do have to wait for the project to be fully completed before we can show the healthy sales effect on our actual reported revenues.
Okay.
I hope that was...
No, you have been. And I'll take the 12-month view in a moment as well, but just want to talk about some of the things that are happening in the quarter. So first, the annuity business, I see that a 13% or a 21% YOY growth in the rental business. Now, and I believe you leased out what, a lakh square feet in the quarter. Did this kind of live up to plan? And I'm also trying to understand, is the rental business uptick a factor at the start of the financial year of an uptick in the in maybe the rentals that you do, or is it a factor largely of the quantum of area that gets leased out?
So the rental increase is generally due to rentals that have already happened. Sometimes when we lease out new properties, there are generally, small rent-free periods or so on that are negotiated as part of the lease. So this is the uptick. What you're seeing is probably a result of rent-free periods burning off or existing leases having escalations built into them. So while our leasing, we did about a lakh, as you said, that's not a large number, but basically we are 100% leased out in terms of all of our non-SEZ space. Where we are generally having a challenge is our SEZ space in Brigade Gardens in Bangalore and World Trade Center Chennai. That's where all of our vacancy is. And unfortunately, due to the lack of clarity from the Desh bill, which was supposed to, extend some of the SEZ benefits, we are having a bit of a challenge on that front. However, both projects are really great, high quality projects. We have some marquee tenants in there. So the leasing is still happening, just not at the larger, size of leases that we expected, or even the pace of, getting the leases on board. But we're not concerned too much in that sense.
Those two, any other newer leasing projects that you're embarking upon? I'm guessing that I'd heard you say at some point of time in our previous interviews that coupled with hospitality, and annual and the rental business, you want to make that a larger portion than what it was in your overall pie in the next 3-4 years than what it was currently. So just some clarity there or some color there.
Yeah, so this quarter we have launched one of our projects. It's one block in office development in Whitefield called Brigade Padmini Tech Park. And that one has actually, that's one of the buildings. So when we launch it, we say that this is a project that's going to go ahead for sale and for leasing. And that's why it's come into the pipeline. We also have another large project of about 1.3 million square feet called Brigade Twin Towers that hasn't yet entered our leasing pipeline. It's still under construction, and we don't generally like to do pre-leasing too early in the cycle because we'd like to get, the full rental by the time the project is looking great and, tenants are scouting for new space. But overall, in terms of our lease rental portfolio, which includes retail and our hospitality, I think the outlook is generally good. For hospitality, especially hotel sector is doing pretty well. Domestic travel has improved. There's a lot of travel happening for exhibitions and so on. So we're positive about both these sectors. In terms of growing these versus the real estate segment, I think overall the share of these may increase, but the entire pie itself is going to increase. Again, we're very bullish on the real estate or residential sector, so that will still continue to grow a lot. So overall, we see good growth prospects for both.
Last couple of questions. One is, I see a lot of research reports on various companies estimate what is the quantum of the annual annuity income that will come into real estate companies, say FY25 onwards, FY26 onwards, because all of the companies and a lot of your peers are trying to do the same thing that you are. Just trying to understand, is there a theoretical, aspirational or realistic target that you've set for yourself and Brigade for reaching a particular number of annual annuity income by a particular year?
So we have a current operational portfolio of around 8.5 million square feet. We have direct visibility of how this is going to increase to around 10 million square feet. And we do continue to have a plan of how we would like to grow that portfolio. Currently, we've been reporting sort of expected stabilized rental portfolio of around 750 crores by say FY25 or so. So I think until we have more clarity in terms of what would the rental rates be for the new space that we are planning, I can't give more detail on that. But for sure, we are committed to our diversified business model. We do want to play in all of these sectors, and we think it gives great diversification to our portfolio, our cash flows. So we are here definitely in the office, retail, and hotel sector. to stay.
I'm sorry, I was just curious about it simply because in your case as well, and please correct us if I'm wrong, but the new capital employed, about 59% of that total capital new employed, capital allocation was increasing focus towards lease rentals, and hence my inquisitiveness.
Sure. I mean, it's a valid question. That said, the capital employed in residential is fairly low because a lot of it, we don't need to take construction financing in many of the projects, provided that the sales remains pretty healthy. And generally it is, financed by milestone payments from the customers, which is based on construction progress. So that's also why our real estate debt is pretty much down to zero. In residential, it's zero, and it's very minimal in the rest of it.
Got it. My final question, because quarter on quarter, there'll be changes upon the pre-sales versus the registrations, so on and so forth. You would have started off, or maybe you, at the end of FY23, you would have thought of what's the quantum of growth that you would log in FY24. You reckon the first quarter gives you the confidence that you'll be able to do that? I don't know if it's a shared target or no, but if it is, I'd love to understand what it was, and you believe you're on track for that or maybe more.
So you're right, we don't give guidance. But on the Q1 numbers, those are very healthy numbers considering we weren't able to get one of our launches out in Q1 itself. So despite that, our team has done really well given the existing inventory that we have. That said, our numbers for FY24 are pretty heavily dependent on launches, as I would say is probably applicable to almost anyone else in the industry also. It's just that inventory moves really fast, and somehow we are in that cycle where you can't put out projects fast enough. They're selling very fast. So we do have a lot of dependency on the launches. They're all in various stages of design and final stages of approval. It's just that we need those approvals to come in. Once they're in, I'm not concerned at all in terms of how fast it'll move or even be able to price higher. So we just need that little approval to come in, and then we'll be good to go. So the confidence from on ground, what we're seeing in terms of customer footfalls, inquiries, conversion speeds, all that is looking great. So we just need the launches to come in.
Hopefully the approvals and the new registrations match the sentiment on the ground, Pavitra. Thank you so much for giving us those details, and all the best for the quarters ahead.
Thanks so much.
Viewers, thanks for tuning into this conversation with Brigade.